Welcome to the Beacon Way podcast. I'm your host, Adrienne Wilkerson, CEO and co-founder of Beacon Media and Marketing. And here's what I know. The best business lessons don't come from textbooks. They come from people who've actually been in it. Every episode, I sit down with entrepreneurs, business leaders, and the professionals who support them. The attorneys, the CPAs, coaches, and consultants who've navigated these waters themselves and now help other founders find their way. Real stories that you can actually use. I'm so glad you're here with us on this episode of the Beacon Way podcast. Let's get into it. Hello, listeners, and welcome back to another episode of the Beacon Way podcast. I'm joined today by Mike Bosma, and comically enough, we are both here in Reno, and yet we're both doing this virtual because technology sometimes just makes that easy. So, Mike, I'm so excited to have you on the show today, and I'm excited to share what you've got with the listeners. Why don't you tell us a little bit about yourself and some of your journey that got you here today?
Sure. No, thank you so much, Adrienne. And I'm a CPA, but I think most people that know me say I'm a CPA with a personality, which is a little bit of an oxymoron. I got into the CPA thing when originally going to be an attorney, going to college, and thought, first person to go through college, I better hedge my bets. A whole bunch of people that go to law school get undergrads in accounting, so I'm going to do that. Tripped on my first tax class and absolutely loved it. Started hacking the tax code from a very young age, being able to press in and see ways to get things done that others hadn't.
Mhm.
And that, I think, when I was in my master's program of tax at UNLV, one of my professors was kind of saying about how certain people in the class had a certain knack for it, and I always thought it was, because I was working at the grocery store, putting myself through school. All these other people worked for the big firms, and they had libraries in their office, and I had to drive to the library to go do my research. So I thought, they have such a hand up. And after I graduated, he said, I was talking about you, Bosman. I was like, there's no way. He goes, how you would come up with answers I didn't even have. And I go, well, that really is because that, when you would assign an assignment, you'd have to go to the cumulative bulletin. That's a publication by the IRS about case law, revenue rulings. But it didn't make any sense to me. It's like reading Greek. So it was all annotated by code section. So I'd read before and after, but then I'd say, well, you want me to read this thing? But actually, the next one actually was more germane to the question. So I would come in. So I just worked hard. So started my yeah, right. Just the school of hard knocks. But I started my public accounting career at Deloitte, the world's largest CPA firm. A couple of years, realized I really have a passion for small business, small and medium-sized businesses, helping people grow and scale. I was at Grant Thornton at that time, number 5 worldwide, and a lot smaller businesses, and we had a great run with them, 12 years. Until they started gobbling up all the Arthur Andersen offices, and they said, we're only going to do work for big companies. So I thought it's time. So that's when I started my entrepreneurial journey, January of 2007. Worst time on the planet to start a CPA firm.
Yes.
right the hedge of the Great Recession.
Mhm.
But I'll tell you, it definitely got me smart about how to help course correct and solve people's problems for them. And it was interesting. It was a couple of years into that, around 2010, 2011, that I was invited as a talk show guest on live talk show in Reno on KOH, and it was John Sanchez and the Wealth Advisors. I was the CPA leg of that, and every Saturday for 2 hours we'd take phone calls for people in all kinds of trouble, and found out I liked it and I kind of had a knack for it, and um, and then that's where it's like that kind of took off, and I started the CPA thing, and then I sold my CPA firm to a large national firm in 2017, and then got it back in 2021. So we could talk
Right.
about that, the exit and then the re-entry of that business. But that's when I got to, in 2021, to not compete with the firm that I had sold to. I became a business broker, so started, doing transactions, a whole bunch of them, helping people exit their business, sell their business. I
Right.
learned a lot, but then when I was able to acquire the firm back, man, if I had a business brokerage and CPA firm, we'd be unstoppable. So,
Right.
we were recognized last year as Inc. 5000 fastest growing firm
Wow.
in the nation, as were you. Congratulations.
Yes, thank you.
And then kind of roll that forward. We've grown and scaled to continuing to do that. Took the radio show to podcast. Really, it was August of last year. Now that I think about it, August of last year. And as I was sharing with you before the show, we just hit 50,000 subscribers and 1,300,000 in views. Um,
Congrats.
so
Yeah.
we're sometimes better lucky than good, I guess. I don't know.
Sometimes. Sometimes yeah, I heard somebody say one time, forget fake it till you make it. You face it till you make it.
You face it.
And
That's good. I like it. That's
I
good.
like that too, because I was like, yeah, that's pretty much what an entrepreneur does. Um, I think we feel like we're faking it sometimes, but really we're facing it and walking head on into the storm, and doing what you have to do till it works, kind of a thing.
Absolutely. Yeah, just dealing with it, right? Coping.
Yeah. Yeah.
Just best at coping.
Yeah, you're making the best decisions you can, but congratulations on those are some really amazing milestones for
Yeah,
sure.
very blessed. Very, very blessed.
Yeah. So tell me a little bit, you sold your firm. What ended up making it so that you bought it back again? And what was that process like?
Well, which really entices, now because I went through buying the firm and then a failed sale, or selling the firm rather than, it wasn't failed. I mean, when what the firm that acquired me didn't recognize is that a big chunk of our firm is consulting. So, most CPA firms, they do tax returns. About 30% of our firm is helping people through various problems.
Mm,
Maybe their accounting needs addressed. Maybe they're being audited by the Internal Revenue Service. Maybe they're reorganizing. There's all kinds of different, and we really had a niche for that and a knack for it. When I was off business brokering in my year of transition with that firm, nobody was in the office doing all that business development, bringing stuff in the door.
sure.
You had not only had 30% of the book of business dry up from last year, it's not replaced by anything this year.
Ooh.
And they're like, oh, well, we have all these staff that we need to keep busy, and there's nobody doing that. And and they tried to recruit people to, come to Reno, and people were like, no, I'm good. So then people started quitting, and they're like, this is a train wreck. We need to exit. But
Mm,
what I've learned now as a business broker, Adrian, is, you know, being able to be replaced as the CEO is job number one to sell your
right.
business. So
Right.
I didn't set that business up for success that way. They should have recognized it. I recognize it now. So when I'm helping people get ready to exit their business, we talk a lot about how do you defocus or unfocus on the CEO, founder, executive, so that other people are doing that. And that's hard. That's a lot of our egos tied into our
Yeah.
business. So, but
Yeah.
yeah, that was that process. And I'll tell you, it was the hardest one of the hardest chapters in my life, because
Mm,
I really thought, when I retired from that firm and was like, I'm going to go do something else. I had been a very successful CPA for a long time. And all of a sudden it was like, gosh, like overnight, the culture of the firm changed. They
mhm,
started identifying me as the problem. Again, you work for now some multi-billion-dollar company. You're
mhm.
some fly on the wall in Reno, and
Right.
right, you're
Yeah,
not a
that's
big part
hard.
of anything, right?
Right.
So, and there's a lot of head games that I know I went through trying, like,
Mhm.
well, I'm getting in trouble for this or that. I'm like, I run my own business for 10 years. I would get mad at myself, but I never had somebody else mad at me for doing
Right?
something. So,
Yeah.
yeah, but that's what I try and prepare people now for. If you're going to be part of whatever you sell to, this is how you need to think about things and not overcomplicate it or undercomplicate it. But when you're answering to somebody else, and you have to make sure that a lot of that negotiation is done before the deal is signed, not after. That was my mistake. I negotiated all that after, and that was a
Oh,
problem. I mean, it
interesting.
really, really
Sure.
was. So there was not clarity on my role after I sold.
Mhm.
And I had a good friend of mine years later tell me, Mike, if you're not on the organization chart, if they had to pencil you in to make you fit, you're not a long-term solution. I thought, good piece of advice. So, because I was never, they were kind of making accommodations for me, but I never really fit their model, because
Mm.
the office was way too small to fit into, their very, very large practice. And again, everybody was trying their hardest. It just
Sure.
was basically set up for failure. So it wasn't a good merger fit.
Yeah. Yeah, that's really interesting. So this brings up some interesting things. Like me as an entrepreneur, this is the second company I've founded, and it's kind of a spin-off of the first one. And there's been times throughout the last 13 years that, we've talked about scaling and selling. And usually that's when things are really hard. And we're just like, oh my God, okay, how fast can we scale this and get out? Yes, time out. We need a timeout. And, but I know like one of the nagging questions well, there were two that were always, beyond the ones of how, are they going to take care of my team and all of those that, every entrepreneur worth their salt keeps them up at night. But it was always like, then what, after those questions, the next set was, what am I going to do with me? And those would always take one of two turns, it felt like.
Mm-hmm.
One was, well, what if they want me to stay? Like, how in the world, because you kind of just said it, like, how in the world am I going to answer for somebody else to somebody else? I haven't done that since 2001.
Right.
Like,
Right.
I always tell people, I'm like, I figured out early on, I suck as an employee. I'm terrible at it. I need to be in charge because otherwise I make everybody miserable,
Mm-hmm.
And so it would just be like, could I do that again? Like, I'm not honestly sure I could. And so that was always one that would go. And the other one was just like, well, what if they don't want me to stay on? Then what do I do with myself? And that one was usually an easier thought process. But how do you like what was your experiences in that? What do you say when, founders ask you questions like that? Because I never had
Well,
anybody to ask.
right, right. Well, that's where our role as business advisors, business brokers. That's a lot of what we do. In fact, I'll just parenthetically, Adrienne, one of my first transactions I closed, we went for a celebratory cocktail after it closed, and they were an engineering firm, and the fees are pretty heavy for this work, but they sat down. He says his name was Jim. Jim told me, he goes, I was wondering when he told me what the fee was, how in the world are you going to earn that fee? And I said, well, Jim, did I earn the fee? He goes, oh, you earned it, but it wasn't for business brokerage. You earned it because you made sure I didn't go crazy. And I
Interesting.
thought that's probably spot on,
Yeah.
because when you're in the both pre-close, getting to LOI to definitive
Mhm.
agreements, then after close, having setting a stage of like, okay, what is this going to be? And every acquirer, every buyer is different. So
Sure.
that's where, knowing what I know now, when like if you were to ask me that question, well, in fact, I would say in your space, there's a ton of private equity. In fact, I
Mhm.
know a few of
Yes.
them. I can make an introduction. So, but not everybody is a good candidate, and it all depends on what the founder's vision for what life is versus what the person that's buying them, and then what their exit strategy is. So
Mhm.
most private equity firms today that are buying marketing creative firms, their model is, we're gonna give you 70 to 80% cash in the barrel head to close. We're gonna put these companies together, but each founder is going to run their unit. So you're just running the
Interesting.
same business you've always run the same way, and
Sure.
your goal is to just continue the trajectory upward. Okay, just not anything crazy. If you're growing
Mhm.
15% a year, just continue growing 15% a year. That's all we need
Mhm.
out of you. And most people can get their mind around that. Now, if you're talking to a private equity firm that's like, "Hey, we want you to change what you've always done," then the radar screen needs to, like, whoa, like what?
Mhm.
Because if you've grown 15% a year and now you're supposed to double your sales, how am I supposed to do that? Because I'm not going to work twice as much. I was hoping to
Right.
work a little less, actually, if truth be told,
Yeah,
right?
that's part of why this is
That's why
conversations
it's
happening.
attractive.
Right. Yeah.
But I'd say that way, it's like being able to do the due diligence on the company that's buying you, whether you have an equity stake in it or not, is to because again, you've poured 20, 30, 40 years of your life into this thing. You don't want it to blow up on day one. You want it to be
Right.
successful, as however the parties define success. So, but
Mhm.
being able, and usually buyers, they don't know that about themselves. They see the lens of through one buyer. This is who we are. This is what we do.
Right.
but but I've done 60 plus transactions the last 5 years. I see a ton. Our firm has seen more. So you're
Sure.
like, well, you can kind of see, are you a heavy-handed leader? What are my directives? What am I supposed to do? Or do I have autonomy? Okay, to make
Hmm.
decisions. Hiring and firing is a big one. Do I have
Yeah, good
autonomy?
point.
Right? Because more like hire, you're great. But especially in a large corporation,
Yeah.
that you got an HR nightmare if you fire as a large company that you don't have as a small company. So
Right.
that those are the questions you ask in due diligence. Now,
Okay.
the second part of that question, Adrienne, which I think is more fun,
Yes.
is because otherwise you sell private equity 5 years, you're going to sell again. Usually the game there is you double your money. So let's say average creative making $1 million a year, going to sell for $3 million. I get 80% on the barrelhead, which is 2,400,000. I invest $600,000 into the new thing. The
Hmm.
idea is if you do this right, you're going to get on the return on that 600 grand that you rolled into the new thing somewhere between 1,800,000 and 2.4. So you can almost double your money depending on what. But if you're going to invest $600,000, you're like, I need to know everything there is to know about you, the buyer.
Right.
Like
Yeah.
who's doing what? I want financials. I do my own due diligence because I'm
Right.
not going to invest $600,000 in something that because there's some fly by night private equity firms out there. So you got to be
Yeah.
smart about it.
Yeah.
But and what I tell people, but if you're just going to sell 100%,
Hmm.
first I tell people the first year you're going to be around. Whether it doesn't matter how long the contract says. For that first year, you're not going to encumber yourself with doing anything other than being available for the benefit of the seller of the
Oh,
buyer.
interesting.
So
Okay.
and if you have big trips planned, that's great. Just let them know in advance. Hey, I'm out of pocket for this 30 days because I'm doing a
Hmm.
worldwide. Go travel, enjoy your life. But that first year is a time for you to resettle as a human and
Hmm.
recalibrate your brain on what the next chapter is. I had a good
Right.
friend of mine, Chris Yount. He sold his business, and he was a guest on the show. So I'm not disclosing anything confidential. But he took a year off, same deal, and he learned how to do
Mm.
woodworking. He has a
Oh,
family
very
farm, a
cool.
family ranch in California. He learned how to do woodworking and lacquer stuff and all this beautiful
Yeah.
because he's like, I don't want to jump into the next thing, until I kind of have my life settled on what I want in that next chapter. And I think that giving yourself freedom is the best thing you can do when you sell, just to reacclimate. And
Yeah.
and
Yeah.
the reality is, many buyers, if you ask them what they want of the seller is they want them to be around and available and will pay them handsomely, not usually to run the business, more to drive sales, right? That, hey,
Interesting.
yeah, I
Yeah.
need,
Okay.
yeah, I will pay you, a commission, because you're still out there, and that way you're still a friend of the firm. We're
Hmm.
still doing quality work, but
Right.
you can drive a ton of revenue for the buyer. You just need to be aligned in doing it, and that gives a couple of different things. You can structure that way, but a lot of times the sellers they say, I don't want to be an employee, I want to be an independent contractor. I have a whole
Hmm.
bunch of my expenses that I've grown accustomed to, the country club, all that stuff.
Yeah.
That gives me revenue to throw my expenses against, and
Yeah.
it keeps me engaged.
Yeah. Well, and that's really smart from a seller standpoint because most often, especially if they're a founder, like, people have been buying them for a very long time. And I know in the marketing world, it's becoming more and more critical to have your founders, to have your CEOs connected. I laughingly call it you need to have the connected CEO. The days of a founder or CEO or both, in my case, being able to just be kind of focused on internals doesn't really exist anymore. That founder's story, that founder's personal brand, that equity in that is growing tremendously. And so what you're describing is a fantastic way for both the seller and the buyer to cash in on that
Right.
equity,
Mm.
that brand equity that's been built over however many years, kind of a thing.
Yeah, yeah, and that creates a win-win.
Hmm.
What you don't want to see is after the non-compete, which now depending on the state you're in, 1, 2, or 3 years,
Right.
that all of a sudden you're in competition with a company you just paid millions of dollars to,
Right.
because they needed something to do.
Yeah. Right. Yeah. Yeah.
Every money you're going to make in profit, I will pay you to do this work, right? But we're going to be
Hmm.
aligned. I'm not going to be fighting for the customers that I bought because they want to go back, to the seller. It's just, but
Right.
yeah, and that's where
That's really
especially,
cool.
yeah, I talk to sellers like, okay, what are you going to do when you're, and I like actually have a podiatry practice back east, and they're like, I'm already in contract to open up a podiatry shop outside of the geographic limitation of my covenant, and I'm going to be in business on day one after I sell. And I'm like,
Oof.
please, please don't do
Can we have a conversation around that?
right. You
Yeah.
you get to,
Yeah.
but it's just, those, and if you've ever been involved in litigation, you'd rather, play nice in the sandbox. If whatever you're going to do, be transparent. I had one deal, Adrienne, the day before close, their largest customer, and I represent a seller, largest customer said, I want to cancel my $1 million order. And they were under contract. They're obligated to buy it. So the founder told them, nope, you have to do this. He goes, okay, well, after this, there's nothing left.
Wow.
So the buyer asked, or the seller asked me, he's like, what do I do? I go, we're going to get on the phone right now and tell the buyer, hey, we got a problem.
Yeah.
Right. And this is what it is. And so it was interesting because he's like, well, they're going to pull out a deal. I was like, I would much rather blow up this deal than get sued after this whole thing goes down in flames, right?
Right.
Because
Yeah.
and you're not obligated to tell them. I would say you are, but I mean, the lawyer said, "Oh," and I'm like, "No, just transparency wins the day, right?" And so,
Right.
and they didn't, the buyer. Remember, this is just like a dating relationship, um,
Yeah.
where everybody's on their best behavior, right? They think the best, positive intent.
Right.
So if you just say, "Oh, hey, I'm just telling you, I just got off the phone. This is," I told them, no, they're obligated or contractually obligated. This is how this impacts our forecast. That, everything. Then they're like, then the buyer was like, okay, no, we can course correct that. We're fine, right? You tell them the day after close, or because they're going to learn, right? Oh, I
Yeah.
told them
Yeah.
that we're. Then now there's bad stuff in that
Yeah.
relationship is disintegrated.
Yeah. It's
Know,
tainted at the
buying and
very
selling a
best.
business is a relationship business. Keep the relationships.
Oh, that's a really good one. So what do you advise? Like, we have shifted. We're not having any intention of selling anytime soon. But for those entrepreneurs out there who are considering it, whether they're looking at retirement in the next 5, 10 years, or they just want to sell and move on to the next thing, what are some of the kind of foundational pieces you're like, you need to get this in place before you consider it? Are there some kind of
No, there is
generic
a
ones?
no,
There isn't?
there's a checklist. There is
There's
a
a checklist.
checklist. In fact, I
Okay.
would say, um, if there's a website, Keystone Exit Partners, KeystoneExitPartners.com, partners plural, exitpartners.com. There's actually a test you can take. It'll take you 5 minutes to take. Tell you if you're exit ready, right?
Yeah.
And I remember when I took that test. So our test. So we put the test together. I took the test just for grins, and I'm like, oh, everything's focused on the business owner, entrepreneur, founder, and then the question was, could you take a month off without it impacting your business? And I'm the number one revenue generator in the firm. So I'm like,
Mm-hmm.
yeah, we would be 1/12 off of our revenue target, right? So uh,
Right.
there's that resources out there. But what I'd say is, Adrienne, if I encourage people, whether or not you're planning on selling your business, doesn't matter. Shouldn't you run it so that it could be sold if you wanted to? Like,
Right.
why is it different? Isn't it just
That's a really good point.
using good business practices, solid, tried and true business practices? So like the one that usually is where people always shortcuts it is accounting, right?
Really?
Oh yeah.
Okay.
Oh, it's
How do they
hilarious.
shortcut it in accounting?
Well, okay, so the founder, they start their business, right? And then they're like, hey, I'm just writing checks. I don't want any overhead. I don't want to hire anybody because you're too small, right? So, and invariably you ask your spouse or significant other, hey, this QuickBooks thing is pretty easy. It's just like writing a check on a computer. Can you just enter that stuff in and pay the bills? Yeah, I can do that, right?
Sure.
So like I said, that's where it starts. So we don't put the infrastructure in to have accurate financials, and then I'm thinking, and again, it's just the owner. So, most owners navigate their business by how much cash is in the bank account.
Mm-hmm.
And I am a firm believer in full accrual accounting, right? We have matching
100%.
of revenue to expenses, right? We accrue our expenses. We book revenue when we incur the time, not when we bill for it, all that stuff. So, um, And that way, you have a good handle on if you're making money. Now, if people say, well, I use cash basis of accounting because I want to know what I'm going to pay for taxes. Like if your accountant isn't able to, in about 5 minutes, calculate what your cash basis of accounting is, right, they're not worth their salt, right? It takes a second.
Well said. Yes.
So run the business like, okay, this is how much money I'm making. But then as you're growing that receivables, right? Like that credit cycle, you're like, why are we giving credit to so many of our clients? It's crushing me on taxes, or it's crushing me rather on cash flow. Then
Right.
you can start to change your business to say, okay, we need to tighten up issuing credit to customers. My extended on a customer, do we need to reel that back? All those, that having good accounting forces all of those discussions, right? Then
Right.
benchmark results back to your industry peers. And so, I remember I had this great conversation. This company rebuilds hydraulic pumps, or a mechanical company for tractors, right? A tractor blows out a pump, you need a new pump.
Right. Very
Uh,
niche, very
very
specialized.
right. $4.5 million in revenue, or $4 million in revenue. And I do their benchmark for them, and I said, you should be making 15% of the top line to the bottom line, like 600,000. They're making $150,000 a year between the husband and wife owners, and they're thinking they're doing okay. 150 is nothing to sneeze at. But I'm like, $4 million, you should be making 4 times that.
Yeah.
And they said, well, they push the financials over to me, Adrienne. They're like, show me where I can make that money. I'm like, okay, well, I look at it.
Yeah.
I said, why and again, we have benchmarks for everything. I benchmark, I go, your inventory is 10 times what everybody else has. Like, oh no, that's how we compete with all the online people, right? Because we have it in stock. So if somebody can, hey, I'm going to have to it's going to take days, but these are pumps for businesses. They need it right away. So we have them on hand. So that way we're not competing with the mail order houses. Okay, great. How much more do you charge for them? Like, well, we charge the same. No, there's a convenience fee, right?
Right. Exactly.
Even if it's $1 more, it's not the same, right?
Right.
And so, and they just saw it, and their eyes open, like,
Right.
oh, right, oh, I get it. So if they're 600,000 now, right?
Yeah.
Ever years later, they said, Mike, I don't know what you do. Just we know we're making more money than we've ever made. Right? These are good problems to have, right? So
these are good problems.
how many business owners, right? They come to me, the business isn't performing the way it needs to perform, the way it's historically performed. Owner's tired, they want to sell, and they're selling on the downslope, right? So every business should be on the upstroke, right? Just otherwise it's sick. It should be growing. If it's not growing, it's dying. So it doesn't have to be going like crazy, but there should be forward momentum, right?
Right.
And if you're taking a step back, you have to evaluate, how did that happen, and how do we course correct it? Oh, good. But those are things, when you ask the question, it's a great question, right? What are the things that people do that they wish they had done when they when they're thinking of selling their business? The other one I would say is the most common, though, is they run their business like a personal checkbook. Okay.
Yes.
And so in fact, I had another marketing company that I helped sell, and they had an offer on the table, a letter of intent, and I looked at it, and I know multiple, so I'm like, multiple of earnings. How much should you be getting? I'm like, I know how much they made. I'm like, this doesn't make sense. And I said, have you shared your financials? Well, they just asked me how much, what my seller's discretionary earnings was. They gave me a multiple of that. I go, well, have they done any due diligence? No. I said, because your financials don't show it. I said, well, I have all my personal stuff in there. And like, she's spending $100,000 a year in wine clubs. Now, I'm not saying she has a problem, but it's definitely a tax and M&A problem, right?
Right. Yes.
So we went through and we scrubbed all of that stuff out, right? She had she had a couple other businesses. She had her personnel that had on payroll doing business for the other business. It was all like, how hard that's going to be to pull apart for a buyer. It's going to make it impossible. So we started a process, took about a year to pull those businesses apart.
Yeah.
She's still got. Now, I would say this, not that I'm in favor. There are rules for deductibility on gifts. Okay.
Right.
$25 per client per year. But, if she wanted to be aggressive on that, she gets to. It's not material to her situation. But what I would say is this, that make sure it's obvious where those personal expenses are, where I call them seller's discretionary expenses. I
Yeah.
like, if they're going to be in the business, have them live below the line, below your net operating income. And just like, that's the business owner slush fund. Okay.
Yeah.
Fine. Or I'm more of a fan of having a separate management company, run those through the management company, your operating company, pay the management company, whatever it is, 20 grand a month,
Yeah.
go crazy, whatever you want to do. That way, when anybody looks at it, including a bank, okay, including a bank, line
Yeah.
of credit, whoever, they're just going to see this pristine, beautiful business that's making the money it's supposed to make.
Right.
Okay.
Right.
And I would say, for every reason, that's the best way to run a business, whether or not you're going to sell it.
Sure. No, that makes a lot of sense. Yeah, we've run into that quite a bit. I am very thankful early on in my very early 20s, one of the companies I worked for, it was a very embarrassing situation, but we had some really good come out of it. The lady that was running the company at the time came back from a conference and handed me this book, The E-Myth by Michael Gerber. And she's like, "Here, you need to read this." And I was running operations and sales and marketing, and it was a pretty, scrappy little startup in Anchorage, Alaska. And so I'm like, "Great." I devoured the book, loved the book. The embarrassing part was then I was like, "Oh man, we're doing everything wrong
Right.
in this company." And so I start bringing all the recommendations to our staff meetings. Talk about naivety and sticking my foot in my mouth up to my knee. So she starts pushing back, and I'm like, I don't understand. Like, this is coming right
It's
out
in the
of the
book.
book.
It's in the
Yeah.
book.
She'd never read it. And somebody had given it to her at a conference, somebody she really respected. And she just came home and handed it to me, not knowing it was contradicting most of what
How she
she
was
was
running the
doing.
company. Right.
Yeah. And she thought I was bringing these recommendations forward. And it was definitely one of those very unfortunate moments where I'm like, well, it's right here in chapter 5 on page whatever, remember?
It was Michael Gerber told me to tell you. Right? Go
And
talk to
she's like,
Michael Gerber.
and so I basically backed her into a corner where she had to admit in front of the entire team that she hadn't read the book. Yeah, I didn't last too much longer at that company. But yeah. So it was an embarrassing thing. But that book really shaped a lot of how I've formed companies since then, because it was really eye opening, not just the different, roles in a company, but that foundational piece of how most entrepreneurs, solopreneurs start a company. And it like you said, it's like this extension of them,
Right.
which is fine up till a point. But then if you're going to sell it or do anything with it past this like mom and pop sole proprietor, you're going to run into problems. And that was stuff I had never
Right.
forecasted because I
Right.
didn't know. But it was
Mhm.
like, oh my gosh, there's this whole world out there. So that I can't say that I didn't make a lot of the mistakes in that book, because I did and still
Mhm.
learned the hard way.
Right.
But it was kind of like, oh, this is what they were talking
Right.
about. That's what Michael Gerber was talking
Right.
about. And I actually
Well,
got to see him live. It was really
actually, me
great.
too. I've met him. Yeah.
Very cool. Yeah, I got to see
Yeah.
him through a BNI, one of their
Okay.
international
Right.
conferences back in the day.
But that's where, as I encourage entrepreneurs, I'm like, you need to know if your business is making the right amount of money. Okay. Just brass tacks, because you're the one steering the ship. So
Right.
you need to be like, okay, because how do you go to your E's and say, I'm paying you fairly if
Yeah.
you're not making any money, right? Every business, to be a viable business, needs to have margin, needs to make money.
Right.
So how do you have that discussion? It's like, because you're not running your business the way you need to be running your business, you're going to short your employees. They're not going to be around for long.
No.
You need to be
Yeah.
able to know, do I have enough margin on my product, right?
Mm-hmm.
How do you look your customers in the eye and say, I'm charging you fairly for what we're doing, right?
Mm-hmm.
I had a staff person approach me one time. This is a year ago. It was just fascinating. 30 something. She goes, how come you're not paying me a living wage? And I'm like, so I chat GPT, like, I have heard of a living wage, but I want to make sure
Right.
I answer knowledge, with some knowledge. And I said, well, no, this is a living wage. She goes, well, that's if you're married. I'm single. It's like, so it's on me. It's on me to pay you 2x. I'm like, No,
Right. No.
you're
Get
paying
a
fairly.
roommate.
Right, get a roommate, right, but I remember through that process, I just said, we charge our clients fairly for what we do. We pay our team fairly for what
They
they do,
do. Yeah.
right? And we make a normal amount of profit, right? So it's, everything is aligned. If one of those is off, right? You're either not going to have enough margin to have a sustainable business, or you're going to lose clients, or you're going to lose your employees. Any one
Yeah.
of those is terminal. So it's like you got to
Absolutely.
know that you're making the right amount of money.
Yeah. No, that's really important. Yeah. I love that. Well, Mike, we're getting close to kind of time here. Is there any kind of one thing you would like to kind of leave our audience with today?
Well, I guess I would say this, Adrian, is if there's a business owner out there and they feel that you know they they're just paying tax for the sake of paying tax, or if they asked their a tax return preparer, why am I paying so much tax? And their answer was because you made a lot of money, you need to get a second opinion. So,
Well said.
and not that we can necessarily change it, although oftentimes we can and we do. It's being able to help explain to a business owner how they feel regarding how profitable or not their business is.
Mm,
Okay, so and I'll give you an example on that. So, your business says you made $1 million, right? So you owed $300,000 in tax, and you're like, well, I don't have $300,000. Like, how did that happen? I
right.
can look at a balance sheet and say, well, if you're selling products, your inventory went up 1 million. Okay, so you bought 1 million more in inventory. That's non-deductible until you sell it. So
Right.
all the cash from the profits of the business went into inventory. So you're gonna feel poor. You're like, I'm paying all this money. I didn't make any money because I didn't take any money out of the business. The business doesn't have a big cash balance, right? It's
Right.
all sitting in inventory. So then you say, well, maybe what you need is a line of credit to finance the inventory until it monetizes into sales. Okay. So
Nice.
it's
Yeah.
just, well, I don't want a line of credit. Well, that's fine, but as long as you're okay feeling poor. Okay.
Right.
It's all good,
Take your
right? But
consequence.
takes
It's
your
one or the
consequences.
other.
All good.
Yeah.
But that's where a lot of people, a lot of preparers are doing taxes, but they don't understand the accounting behind it, or they have never really taken an interest in it. And we live by that. Right? It's like if because the reverse is terminal for a business. And I'll explain it this way. I had a client. They got they were an event planner. They got 50% up front for an event, and then the event was up to a year later. So, well, they were feeling flush,
For a
okay,
while there.
for a
Yeah.
while, right? Because they had all this cash, they didn't have to do anything for it, so they're feeling like this is great.
Yeah.
And then when all of a sudden they had to provide all these services, they'd already spent the money. The money was gone,
Yeah.
and so then all of a sudden, like taking the business out because
Hmm.
they didn't understand. They were like, "Oh yeah, this is great. We got a windfall. I got this. I had a fifty thousand
Right.
dollar deposit today. Let's go party."
Right. Yeah.
No, no, you got to leave that in the bank, leave it
Yes.
alone because you're going to have $40,000 of expenses against it. And you're not
Hmm.
going to earn your $10,000 in profit until you deliver it. And
Right.
sometimes it's going to cost, right? So
Yeah.
being able to have somebody that really feels more like a CFO type of person explain your world to you,
Hmm.
much
Yeah,
better
that's
than
really
just getting
cool.
a tax return saying pay the freight.
Yeah, absolutely. That makes sense. So, if somebody wants to keep this conversation going with you and this has really struck a chord with them, what's the best way to get a hold of you?
Phone number 775-786-4900. My email, mbosma at keystone.cpa, mbosma at keystone.cpa, or, you know, Google, ChatGPT, Keystone
Yes.
CPAs, or Mike Bosma. We're pretty easy to find.
Yeah, awesome. And for those of you who might be interested, we'll make sure we put all that information, we publish it with this episode. So keep an eye out for that in the comments or the notes, depending on where you're connecting with us. Well, thank you so much, Mike. This has been an amazing conversation. As always, very much enjoy getting to talk to you. And thank you for everything you do in our local Reno community. Really, really appreciate you.
No, very, very welcome. Thank you for having me on.
All right. Take care and have a great day, Mike.
You do the same. Thank you so much.
Thank you so much for being here with us today on this episode of the Beacon Way podcast. And a huge thank you to our guest for sharing their story and their expertise so openly. These are the people who charted the course through the hard parts and come back to help the rest of us navigate through our own journey. If today's conversation resonated, please share it with a fellow founder who needs to hear it. Subscribe, leave us a review, and come find me at beaconmm.com or connect with me on LinkedIn. I'd love to continue the conversation there. Until next time, keep building, keep leading, and remember, there's always a way through. This is the Beacon Way podcast, inspiring leaders and elevating business.